It's your last day at work. After 35 years of early mornings, stressful deadlines, and endless meetings, you finally walk into your boss's office, smile, and say the words you've been dreaming about for decades. I quit. You walk out carrying nothing but a small box of personal belongings. No alarm clock waiting for tomorrow. No emails. No commute. You're only 55 years old, and according to your investment account, you've done everything right. Your portfolio has just reached $2 million. You've read the books. You've watched the videos. Every retirement calculator says the same thing. Follow the 4% rule. Need $80,000 a year? Multiply it by 25. $2 million. Simple. For a moment, life feels perfect. Until 5 years later. You open your investment account. Instead of growing, it's shrinking. Healthcare costs are higher than expected. Taxes are taking a bigger bite than you planned. Groceries cost noticeably more than when you retired. And suddenly a terrifying question enters your mind. Did I retire too early? Here's the uncomfortable truth. Millions of people are building their retirement plans around a number they've never actually questioned. Not because it's completely wrong, but because it's incomplete. And that difference could determine whether you enjoy 40 years of freedom, or spend your 70s wondering if you'll run out of money. By the end of this video, you'll know the real number you need to retire at 55 with an $80,000 lifestyle, and it may be hundreds of thousands of dollars higher than you've been told. But before we calculate that number, we have to expose the 3 invisible expenses quietly destroying retirement plans every single year. The first invisible expense: taxes. Let's meet someone we'll call Mark. Mark is 55 years old. He's disciplined. He invested consistently for decades. He finally reaches the famous $2 million milestone and retires, convinced he can comfortably withdraw $80,000 every year. Everything looks perfect on paper. Until the money actually lands in his bank account. Here's what many people forget. If most of your retirement savings are sitting inside a traditional 401k or IRA, every dollar you withdraw is generally treated as taxable income. That means withdrawing $80,000 doesn't necessarily mean spending $80,000. A portion disappears before it ever reaches your wallet. Think of it like filling a bucket with a hole in the bottom. You're pouring in enough water, but you're not keeping all of it. That's what taxes do to retirement withdrawals. It's called tax drag, and over 30 or 40 years, that drag can quietly remove hundreds of thousands of dollars from your portfolio. Already, the famous $2 million doesn't look quite as comfortable. But here's where it gets worse. Taxes aren't even the biggest surprise. The expense almost every retirement calculator ignores. When people imagine retirement, they often picture turning 65, enrolling in Medicare, and enjoying affordable healthcare. But that's not what happens if you retire at 55. There's a 10-year gap. 10 years where you're responsible for buying private health insurance. And depending on where you live, your coverage, and your medical needs, those premiums can add up to thousands, or even tens of thousands, of dollars every year. Imagine retiring because you believed your expenses were $80,000 annually, then discovering your healthcare alone costs far more than you expected. That's not a budgeting mistake. That's a retirement plan built on missing information. Mark didn't expect this. Neither do most people. But healthcare is only the second leak in the bucket. The third one is even more dangerous because you barely notice it happening. The silent thief called inflation. Imagine handing your younger self an $80 grocery bill from 20 years ago. Now imagine trying to buy the exact same groceries today. The prices aren't the same. Your lifestyle didn't necessarily become more luxurious. Money simply became less powerful. That's inflation. It doesn't arrive with headlines or warning signs. It quietly makes everything more expensive. Now imagine retiring at 55 and planning to spend $80,000 every year for the next 35 years. If inflation averages around 3% annually, that same lifestyle could eventually cost well over $140,000 a year just to maintain the same standard of living. Think about that for a second. You're not planning for today's retirement. You're planning for tomorrow's prices. And if your investment strategy ignores that reality, your future self will pay the price. At this point, Mark realizes something uncomfortable. The famous $2 million target wasn't wrong. It just assumed a much simpler world than the one he's actually living in. So the obvious question becomes, if $2 million isn't enough, then what is? Because once we run the real numbers, you'll understand why many financial planners quietly aim for something much closer to $2.5 million, or even $3 million. And surprisingly, the reason has less to do with spending, and everything to do with what happens inside your investment portfolio after you stop working. Let's do the math. Asterisk, is $2 million enough? Asterisk, what is the real number? Asterisk, why do planners say $2.5 million to $3 million? Asterisk, what happens after retirement that's so dangerous? The math that changes everything. So, how much do you actually need? Not what a headline says. Not what a retirement calculator spits out after asking you 3 questions. The real number. To answer that, we need to stop thinking like someone who's saving for retirement. And start thinking like someone who's already living in it. Because the day you retire, your relationship with money changes forever. For decades, your investments had one job. Grow. Now they have 2 jobs. They have to grow. And they have to pay your bills. That changes everything. Let's go back to Mark. He's 55. He has exactly $2 million invested. He wants to spend $80,000 a year. At first glance, it looks perfect. 4% of $2 million is $80,000. Case closed. Except retirement doesn't happen on paper. It happens in the real world. Imagine Mark retires in January. He's excited. He books a vacation. He starts volunteering. He spends more time with family. For the first time in decades, life feels like it's finally his. Then 6 months later, the stock market drops 20%. His $2 million portfolio suddenly becomes $1.6 million. But here's the problem. His bills didn't fall by 20%. His grocery bill didn't shrink. His insurance company didn't lower its premiums. He still needs money to live. So he keeps withdrawing. And without realizing it, he's doing the one thing every early retiree hopes to avoid. He's selling investments while they're down. This is where retirement math becomes emotional. When you're working, a market crash is frustrating. When you're retired, a market crash can permanently change your future. Because every share you sell today is one less share that can recover tomorrow. Financial planners have a name for this. Sequence of returns risk. And despite the complicated name, the idea is surprisingly simple. Imagine 2 retirees. Both start with exactly $2 million. Both earn the exact same average return over the next 30 years. One experiences great market returns in the first 5 years. The other experiences terrible returns first and strong returns later. Average return? Exactly the same. Final outcome? Completely different. Why? Because the second retiree had to sell investments at low prices while funding everyday living expenses. By the time the market recovered, much of the portfolio was already gone. This is why retirement isn't just about how much money you have. It's also about when the market decides to test you. Now let's add everything together. Taxes. Healthcare before Medicare. Inflation. Unexpected repairs. Helping family. Longer life expectancy. Market volatility. Suddenly, the famous $2 million target starts looking less like a destination and more like the absolute minimum. That's why many financial professionals now build retirement plans using more conservative assumptions. Instead of planning for perfection, they plan for uncertainty. Instead of assuming every year will be average, they assume some years will be terrible. Because in retirement, surviving bad years matters more than maximizing good ones. So what happens if we build a plan for reality instead of optimism? Let's compare 2 portfolios. Portfolio A, $2 million. Everything has to go right. Markets cooperate. Healthcare stays manageable. Inflation behaves. Taxes stay predictable. No major emergencies. There's very little room for error. Now look at Portfolio B, $2.7 million. Immediately the picture changes. You have a larger cushion. Withdrawals represent a smaller percentage of your total investments. Temporary market declines become easier to survive. Healthcare costs become less intimidating. Inflation becomes less destructive. Most importantly, you gain something that's almost impossible to calculate. Peace of mind. Because retirement isn't just about having enough money. It's about sleeping well at night. It's about not checking your investment account every morning wondering whether today's market decline means canceling your vacation next year. Now, does this mean everyone needs $2.7 million? No. Your number depends on your lifestyle, where you live, your taxes, and how much guaranteed income you'll receive. But here's the lesson. If your retirement plan only works when everything goes perfectly, you don't have a retirement plan. You have a hope. And hope is one of the riskiest investment strategies ever invented. But here's something most people don't realize. Even if you save $2.7 million, you could still make one mistake that quietly destroys your retirement. It has nothing to do with your portfolio balance. It has nothing to do with stock picking. And surprisingly, it starts with where your money is sitting. Because retiring at 55 isn't just about how much you've invested. It's about which account you're withdrawing from first. And that's where one strategy, used by many experienced early retirees, can make the difference between financial stress and financial freedom. Let's build that bridge. The bridge that most early retirees never build. By now, Mark has accepted something most people don't realize until it's too late. Retirement isn't just about reaching a number. It's about surviving the decades that follow. But there's one more mistake hiding in plain sight. Even people who save enough money can still run into trouble because they keep it in the wrong places. Think of your retirement like crossing a river. On one side is your working life. On the other is complete financial independence. Most people spend decades building the boat. Very few think about the bridge. Here's what I mean. Imagine you've worked hard for 30 years and almost all of your wealth is inside retirement accounts like a traditional 401k or IRA. Those accounts are fantastic for growing your money. They offer tax advantages. They encourage long-term investing. But when you retire at 55, they introduce a new challenge. You still have 10 years before Medicare eligibility. You may want flexibility over when and how you withdraw money. And depending on your situation, drawing from tax-deferred accounts alone could increase your tax bill or reduce your financial flexibility. That's why many early retirees don't rely on just one bucket of money. They build multiple buckets. Imagine 3 separate containers. The first holds your long-term retirement investments. This is the money designed to keep growing for decades. The second is a taxable brokerage account. This gives you flexibility to cover living expenses before relying heavily on traditional retirement accounts. The third is your safety bucket. Cash or highly liquid, lower-risk investments that can cover several years of expenses if markets become unpredictable. Think about why this matters. Imagine the stock market falls 30% during your very first year of retirement. If every dollar you need comes from selling investments, you're forced to sell when prices are low. That's like selling your house during the worst housing crash simply because you need cash today. No investor wants to do that. Yet thousands unknowingly do exactly this every time markets fall. Now imagine a different scenario. Instead of selling stocks immediately, you spend from your cash reserve. Your investments stay invested. Months pass, then years. The market begins recovering. Because you weren't forced to sell during the downturn, your portfolio has a chance to rebuild itself. That simple decision could preserve hundreds of thousands of dollars over a long retirement. This isn't about predicting crashes. No one can. It's about preparing for them. Because history has taught us something remarkably consistent. Markets recover. But only if your investments are still there when they do. That's why experienced investors don't just build wealth. They build flexibility. And flexibility is often the greatest form of financial security. The shift most investors never prepare for. Here's another transition almost nobody talks about. While you're working, your investment strategy has one objective. Grow your wealth as quickly as your risk tolerance allows. That's the accumulation phase. Market drops? You buy more. Volatility? You stay invested. Time is on your side. But retirement changes the game completely. Now you're entering what's called the distribution phase. Your investments aren't just growing anymore. They're paying your paycheck. Every withdrawal matters. Every market downturn matters. Every tax decision matters. Imagine owning a fruit tree. While it's young, your goal is simple. Help it grow. Protect it. Water it. Wait. But once the tree matures, your goal changes. Now you're harvesting fruit every year. If you pick too much, the tree weakens. If you neglect it, the fruit goes to waste. Your retirement portfolio works the same way. The goal isn't squeezing every last dollar out of it. The goal is creating a harvest that can continue for the rest of your life. That's why many retirees gradually shift part of their portfolios toward investments designed to generate steadier income and reduce unnecessary risk. Not because growth no longer matters, but because stability becomes just as important. The biggest mistake isn't becoming slightly more conservative. The biggest mistake is pretending you're still 35 years old when you're living off your investments. And this brings us back to Mark. At the beginning of this video, he believed retirement was about reaching $2 million. Now he realizes something much bigger. The number got him to retirement. The strategy is what keeps him there. But there's still one final question. If the real target is closer to $2.50 to $3 million, how do you actually get there without feeling overwhelmed? Do you save more? Invest differently? Delay retirement? Or is there a smarter way to close the gap? Because the answer isn't as painful as most people think. In fact, a few decisions made years before retirement can be worth far more than chasing the next hot stock. Let's build your plan. The plan that turns a goal into reality. Let's go back to where we started. Mark is standing outside his office for the last time, convinced that reaching $2 million means he's set for life. But now, after looking at the math, he realizes something important. Retirement isn't a finish line. It's the beginning of the longest financial project he'll ever manage. The decisions he makes during the next 30 or 40 years matter just as much as the ones that got him there. So how do you put yourself in the strongest position possible? It starts with a simple shift in thinking. Stop asking, when can I retire? Start asking, when will my money be able to support the life I actually want? Those are two very different questions. The first is based on age. The second is based on math. And math doesn't care whether you're 55, 60, or 67. It only cares whether your portfolio can survive everything life throws at it. So here's a practical roadmap. Step 1. Know your real annual spending. Don't guess. Go through your bank statements and credit card transactions from the past year. Separate needs from wants. Then estimate what will change in retirement. Maybe commuting costs disappear. Maybe travel expenses increase. Maybe healthcare becomes one of your biggest monthly bills. The more accurate your spending estimate, the more accurate your retirement target will be. Step 2. Build in a margin of safety. One of the biggest mistakes investors make is planning for the average year. Life isn't average. Cars break down. Roofs leak. Family members need help. Markets fall. Unexpected costs don't ask whether you're retired. A portfolio with breathing room gives you choices instead of panic. Step 3. Increase your savings rate before increasing your investment risk. Many people spend years looking for the perfect stock, the perfect ETF, or the perfect strategy. But often, the biggest improvement comes from something much simpler. Saving an extra 5% or 10% of your income. Investing consistently. Avoiding lifestyle inflation every time you get a raise. Because while higher returns are never guaranteed, a higher savings rate is something you can control. And control is one of the most valuable assets in personal finance. Now let's address the question many viewers are probably thinking. What if I'm behind? Maybe you're in your 40s. Maybe you've only recently started investing. Maybe your retirement account is nowhere near where you hoped it would be. Here's the encouraging news. Retirement planning isn't about comparing yourself to someone else. It's about making the next decision better than the last one. You don't have to fix everything today. You just have to move in the right direction. Sometimes that means increasing your monthly investments. Sometimes it means paying off high-interest debt first. Sometimes it means delaying retirement by 1 or 2 years. And while that may sound disappointing, those extra years can make an enormous difference. Not only do you continue contributing to your investments, but your portfolio also has more time to grow. At the same time, you're shortening the number of years your investments need to support you. It's a powerful combination that many people underestimate. So if you're choosing between retiring at 55 with constant financial stress, or retiring at 57 with confidence, the better answer is usually obvious. Because financial independence isn't about leaving work as early as possible. It's about never being forced to go back. The bigger lesson. Let's end with one final thought. The internet loves simple rules. The 4% rule. The $1 million retirement. The magic number. They're appealing because they're easy to remember. But your life isn't average. Your goals aren't average. And your retirement shouldn't be built on average assumptions. The truth is, the difference between someone who enjoys retirement and someone who worries through it often isn't intelligence. It isn't luck. And it isn't finding the next great investment. It's planning for reality instead of perfection. Reality includes taxes. Reality includes inflation. Reality includes healthcare costs. Reality includes market crashes. The people who retire successfully aren't the ones who hope those things won't happen. They're the ones who assume they will, and prepare anyway. So, how much do you actually need to invest to retire at 55 with $80,000 a year? For many people, once you account for taxes, healthcare, inflation, and a longer retirement horizon, the answer may be closer to $2.5 million to $3 million than the traditional $2 million. Will everyone's number be exactly the same? No. But the principle is, retirement isn't an age. It's a financial equation. And every decision you make today changes the answer. So don't chase someone else's retirement number. Calculate your own. Because the day you finally walk out of work for the last time, the goal isn't to hope you've saved enough. The goal is to know. If this video helped you see retirement differently, subscribe to Elmin Finance. Every week, we break down investing, wealth building, and retirement planning using clear, math-backed explanations instead of financial myths, so you can make smarter decisions with every dollar you invest. And before you leave, I'd love to hear from you. If you could retire tomorrow, what annual income would make you feel truly financially free? And do you know the number it would take to get there? Because once you know your number, you're no longer guessing. You're planning. And that's where real financial freedom begins.